Welcome, everybody, to High Stakes Deals. I'm Greg Foster, and this is my partner,
Brandon Locascio. Let's go.
The one and only.
Thought you had a nickname for me or something.
But anyways,
let's go.
Welcome back, Brandon. This is exciting. I mean, there's a lot going on.
Dude,
Corey,
listen.
nice to see you.
Yes, we're here.
There's a lot going on.
There's no place I'd rather be, by the way. This
really?
is the most fun I have. I'm telling you guys.
Oh, okay,
it's almost like, you know, no place I'd rather be than Disneyland or something. I don't know. But this is where I want to be.
Get you a t-shirt.
Because as much as I love what we do, all the real estate deals and running around.
You love talking about it.
I've grown to really love being in the studio.
Yeah.
Maybe it's Corey, the cameras, the lights. I don't know. Hearing myself talk for an hour, it's like therapeutical. You know, it's like I'm in therapy with myself.
You're right. It's a good vibe, and maybe it is because of Corey, but it is a good vibe. It lends itself to talking. You know what I mean? Like, do you want to pontificate all day or just
you do all your talking at the podcast and you get out of here. You're done, right?
But
So what are we talking about today?
Well, listen.
Let's give him a high note here.
Raising private equity. How do you raise private equity, and how do you get started, and everything surrounding that topic? That's a big topic, and there's a lot of details that go into that. I mean, we could talk about the high level issues, and what are your thoughts?
Well, I think one way to jump in is to really start from the standpoint of most real estate investors, not all, but most real estate investors when they're starting their career, right, starting to figure out what they're going to buy or buying their first deal, whatever the case may be. They might have enough money to do their first deal if it's a small one, but quickly if they're trying to grow, when they get to that second deal, that third deal, or that deal that's now twice the size or 3 times the size, they quickly realize they can only go so far
by themselves
financially on their own capital, because each deal you need what? A down payment. If you're buying properties, you got to remodel. You need money to remodel them. You need reserves, right? So you got to cover certain things if a tenant doesn't pay you or something. So particularly when you're buying these rental properties, you got to go into them with a certain amount of cash.
How much money is that? What is the percentage of? So if a property costs $1 million,
that's a great question actually.
What is the number that we need for the down payment? I don't.
You're going to need at least 30% down on that deal. That's $300,000 right there, Corey.
And the reason it's 30%, so if it's a residential house, like you're just buying a house as a rental property, right? One single family home. You might be able to do it 20%, 25%. That's probably more standard as an investor buying a house. But when you get into commercial properties, the commercial lenders want you to have 35% typically, sometimes 30, sometimes 40. So we've always kind of been in that range. We had one deal last year that when we bought that we put 50% down.
That's a lot.
Yes.
Well, because they want you to go into to it well funded. The commercial banks don't want to mess around and have a chance that you're over levered and something changes and a bunch of tenants move out and now you can't pay the mortgage.
What is the difference between like a multifamily? When does it become like a commercial property?
After 4 units. So 5 units and above, that's a commercial loan, Corey, and the dynamics change a little bit. Single family up to 4plex is under the residential financials.
And there's pros and cons of both, because residential financing, yes, you can put less down. Typically, maybe the rates will be a little bit better. And, so if you're doing some onesie, twosie, 4plexes or something, or 2plexes, some houses, that's actually a benefit to be able to get that residential financing. But once you want to start growing into the bigger properties, which the bigger properties bring their own sets of all these benefits, right? Economies of scale. Now you have more tenants paying you. You can make bigger home runs on these types of deals. But yeah, maybe the downside of the financing is you got to typically put a little bit more down. And going back to your first question of how much do you really need, it's usually about 40 to 50% total if it's a value add deal. In other words, if you really take that 30, 35% down payment, you take the fact that you're going to be spending money renovating all the units, maybe painting the buildings.
How much? What percentage is that? Do you think is like?
It's probably another 20%. Like for example, the deal we just bought for $8 million, we're coming in with $4 million in cash.
Okay.
Right, and you can kind of look at it like a couple million to remodel it and a couple million to put down. It's rough,
and we're taking
speaking,
an aggressive strategy.
But that $4 million is half of that 8, right? So it's 50%. So, and that is because
how much of it was down? Like 3.
Closer to 2.
Okay. So it's another 2 in renovation.
Exactly.
Interesting.
And reserves.
And so you could see when you're doing these deals, I mean, even if you're doing the residential deals and doing 20-25%, that still adds up fast, right? But you could see, especially if you start growing and going to these commercial deals, you're just going to run out of money quickly.
Well, it adds up. It adds up fast, and hence probably why this whole syndication and private equity has become more and more popular. Right. It's hard to do it on your own. Just your example right there, Corey, $1 million purchase, $300,000 plus another $200,000 for everything else. It gets expensive fast.
Yeah, and so to put in perspective, right, tied in like what we did, right? So my brother Chuck and I, we started together with one $80,000 house,
right?
And we shared the down payment for that little thing, right? It was 25 grand. We bought a second $80,000 house. There's two little cheapies in Bakersfield, right? But just buying those two little cheapies, we kind of started running out of our, we was like, okay, we put 25 down on this one, 25 on that. Okay, we're like, what do we do next?
Yeah.
So,
and then Foster got in.
Then we called Foster and Kevin, right? So our first thing was, okay, use our own money, my brother and I, to buy our first couple of houses.
Right.
Then we gotta expand the partnership, right? So then we invite Greg and Kevin in, and now the four of us are able to buy a triplex with our own money. And then the four of us are able to buy a 5-unit with their own money. So it's kind of the same thing. Chuck and I bought a couple little properties, and the four of us bought 2 more properties that were slightly bigger, but then we were out of money again.
But all of them falling under residential.
All those, except for the 5-plex technically. But yeah, exactly. So, but then we were out of money again.
Right.
So, and in a way, that was a good thing, right? You want to run out of money because in real estate, you kind of want to be, real estate heavy, cash poor, not too cash poor because you need some.
You've never heard that before.
But that's just what happens because we're like, oh, this is working. Let's buy some more. So now all of a sudden, we're out, we're out of money again. We're like, shit, what do we do? So now we're like, okay, we got to grow this thing. So we're ready to go to our next deal, which was a 12-unit.
And all the properties at this point are cash positive?
Oh, yeah. They're all cash positive. They're all making money. Okay. But, it's like one of those things where you own these properties. Maybe you're making a couple grand a month from this one, a few grand a month from that one, especially when you're first starting out the small ones. Yeah, and a lot of that money we're reinvesting back into like fixing up the roof or painting or doing certain things. And so it's not like it's spinning off a ton of cash.
Right.
They're cash flow positive, but it's not enough money to then have another 150 grand to go buy the next one, right? So it would just take too long of waiting. So now we're going, man, we can't just sit still. We got to buy our next one, right? And so that kind of brings this conversation full circle. Like you can see, even with 4 partners, we quickly ran out of our own personal money, even 4 guys that actually, do pretty well personal income wise, but just by way of us, hey, we're going to grow this thing. What do we do? And that was our first, we had to sit there and go, okay, it's time to start raising capital. It's time to start raising private investor capital that, other people that can invest with us so that we can go bigger on these deals and go faster. Because if not, we're going to sit here and take 5 years to buy, a property every couple of years or something, versus what we've now been able to do. And so I think we're not unique in that story. A lot of people go through the same thing. It's actually a very common story of people getting into the business and they got to figure this out quickly.
It becomes apparent pretty quickly that the cash flow is great because and Brandon does a lot of the underwriting on the properties, and they've all cash flow from the get-go, and these are good deals. But it becomes apparent that you're going to need more units under management because it just becomes a scaling thing. You got a 50-unit deal and another 50. Soon enough you're under 200 doors under your management, and now the money starts really.
Yeah. So your point is, if somebody's doing this as kind of I don't want to say a hobby, but if someone's like, I just got a couple of rental properties, because a lot of people, I got a couple of rental properties. I don't want to grow this huge. I don't want investors. I just want to have a couple of rental properties with my own money. That's great, by the way, because they could just put some nice 30-year mortgages on them, and when they're ready to retire, they might have 2 or 3 homes paid off, and they're cool.
And we know plenty of people that do that.
For us, it was like, well, we're all 4 here to build this into a real business. Otherwise, we could just do this separately and go back to the route I was just talking about. And so when you're trying to build into a business, it quickly becomes, all right, it's time to figure out how to raise capital, right? And that's a kind of a scary thing when you first start thinking about it, right? Because there's a lot of, when you take someone's money, that's a big responsibility. Let's put it that way. When it doesn't matter if it's $1 or $1 million, which is probably our biggest investor to date.
It's probably not a hard sell if that's a good that's a good number. Congratulations. That's
Thank you. Yeah, appreciate it. Our by the way, our investors at the moment that are in our current deals probably range from, I'm trying to think of the smallest one. It might be $10,000. We've let a couple people in on some smaller ones. Average people are probably like 75, 50, 75, 100. And then we have $1 million guy that's put $1 million.
$10,000 one.
Hey, listen, we would love to have you in, man. That would be amazing.
We'll go shoot some video up there too, by the way, Corey.
Oh man. But I guess going back for a second of what someone does, right? What's like the first, and I'm gonna ask you, Greg.
Yeah.
If you're starting out, the next guy, the next Gregory is starting out. Yeah.
You're so official.
20-year-old something, whatever. He's getting going. He's got a good deal he wants to do. Maybe he's got to put $200,000 or $300,000 down. He's got $25,000 of his own money saved up, but that's not enough to get this thing done. Yeah. What does Gregory do? Where does Gregory go, do you think, to start finding an investor or two?
Yeah, I mean, it's a good question, but I mean, it's obviously going to come from your inner circle. Yeah. That's where you start. That's where
you're saying friends, family, people that you have a relationship with,
course,
who are most likely to take a chance on you, right? Especially if the deal makes sense.
It just becomes
versus going out to strangers.
Right.
Your
it
first
just becomes the first place everybody goes, and they should, because if you're an upright guy, they have to trust you. Yeah. You know what I mean? It just becomes a trust thing. Even as you get to a larger scale, as we're starting to grow ourselves, it just becomes easier when people trust you.
I mean, if the paper trail is cash positive, that seems probably not like the hardest sell.
Of course.
I would imagine so.
No, Corey, it becomes easier.
I think you're totally right.
Yeah, I think it totally becomes easier, but there's still an emotion tied to it.
Well, yeah, and I think the question is like, you sort of hinted to it that, sometimes people know you as they know you, right? So like, what does Greg know? He's 20 years old, full of piss and vinegar. I've seen him running around here causing trouble. I'm like talking as if I'm your uncle, 20. Right? He's like, this Greg's a pain. Hey, what does he know about real estate? Yeah, it looks interesting, but I don't know if he's going to mess it up, right? No, but those are real. So that's kind of the good and bad of that family network, right? It's like you got to... you'll have some people that will. The bottom line is, you have some people will believe in you, some people won't. Of course, but you got to kind of push through that. And I think back to your point, if the deal makes sense, if you've done your homework, I mean, you can't raise capital if you don't have some, knowledge about what you're doing, right? I mean, again, that's why with us, we did a few of them, and then it was really easy to sell to the investors, because not only was the deal good, but we already had some that we have done ourselves. Yeah. But and again, everybody's got to start somewhere. So there are situations where you can probably raise capital if you don't have a lot of experience, but it definitely helps to have something, figure a way to get your hands on something.
I mean, it's the trust, it's a good product, a good property that cash flows. It makes everything easier. But when you have a time when people start really trusting you, you know what I mean? Everything just becomes real easy. Money just starts flowing.
So if you were going to go on your first deal, your second deal or whatever, it's time to raise some capital. But your first deal, you're raising some money, right? And what you said a minute ago, you're going to go around to your friends and family and some of the people you have close relationships with, and you're going to pitch them on this idea of joining on a 8-plex you're buying, right? Yeah. What's the first thing you're going to do? What are you putting together? Like, what are you physically bringing them? How's your pitch going?
Well, you have to put together like a pro forma, some type of investment packet that shows the numbers and shows the property. Right. Yeah. I mean, they're going to want to know you have a system behind you. Yeah. And that goes to scale too, though. You know what I mean? Like, people are trusting you, but they also see you have a system behind you that you can get the job done. Yeah. You know what I mean? So that's important too, to have a process.
No, you're totally right. And I think identifying a big part of that is like the why, right? Because that's the first thing which Corey touched on. Like, they're gonna ask, why this deal? Let's see the deal. Why do you want to buy this deal, Greg? Right. Well, because the numbers the rents are 1,000 and they should be 2,000, and we're getting a great deal on it. Look at the comps, and we can buy this and do X, Y, and Z to it.
Do you think having a good plan laid out makes this a lot easier to sell? I mean, look at the deal we just closed. Yeah. What was the plan? The guy.
Well, if we didn't have a plan, we would have never raised any money. We've never closed it. So you got to have a good plan.
Yeah, you got to have a good plan. And our plan was pretty basic, a good value add plan.
Yeah, and I think that's you're exactly right. You got to have a plan. You got to know your numbers, and But here's the other thing, right? I think there's a mistake that some people make when raising capital for real estate deals.
What is that?
Well, they think they got to have the money before they tie it up. So, and I know this is a big thing that, Cardone always says. It's like, dude, get the deal under contract and then go find the money. Yeah. Because there's no way you're going to call around a bunch of your investors and start putting packets together and get anybody to take you seriously on a deal you haven't even made an offer on. So you got to have enough of your own wherewithal to say, hey, this deal makes sense. Yeah. I don't have all the answers yet.
How many days do you have to figure that out?
Well, that's a good question. So in most cases, if you tie a deal up, you're going to have anywhere from 2 to 4 weeks.
Right.
By the way, but if you tie it,
that sounds like a stressful 2 to 4 weeks.
Yeah.
That sounds stressful as fuck.
Well, now you're starting to get it, Corey. Yeah. You're starting to get it.
Yeah. Exactly. So
welcome to the jungle.
Wow.
well, like the deal we just bought. I mean, we opened escrow. We gave the guy $140,000. And we had no way how we were gonna. We didn't know how we were gonna pay for the $8 million to buy this damn thing. So we had to spend.
But honestly, Brandon, like the first
you gave him $140,000, and then you had 2 to 4 weeks to find the other $3.6 million.
Right, more or less. So we had within 30 days to come back to him and go hard on that money.
Right.
So now if we walk away and don't close the deal, we lost that money forever.
100%.
Yeah.
And so we even when we came back to go hard, it was like, well, we still don't have it all figured out, but fuck it, we really believe in ourselves and we're gonna get this deal done. So there's that saying like, burn the boats.
Right.
Sometimes you got to burn the boats. And we almost always get in a situation with our deals where there's like this kind of like, tipping point of it. It's like, all right, well, we got to raise $4 million. We're pretty sure we've got $1 or $2 million kind of committed from investors. We think we have good momentum. The deal really makes sense. Yeah, let's just go hard on the 140. Fuck it. Worst case scenario, we lost 140 grand. It would be very painful, but at the same time, we can't let this deal walk away. And this guy's putting lots of pressure on us. Like if we don't go hard, he's not going to give us more time. So we went hard and we burned the boat.
Right. That's true. And he makes a good point. And that's how things actually get done, Corey. Just go fucking start them. You know what I mean?
Yeah.
Or you an analysis paralysis situation.
Yeah.
But it was a progression too. You can't just come out of the gate
on your first deal and do that, of course,
put in even a 25 unit deal. Yeah. But once you get there, it's confidence that you can execute. And
it's a great point. And I think that's the whole thing, right? So like if someone's starting off on what we would consider like a normal size first deal, right? Maybe it would be a $5,000 or $10,000 deposit, right? Maybe a $20,000 deposit. The numbers are so use that same scenario. Greg's got his first deal. He's gonna go. He's got to raise he's got to come up with $200,000 or $300,000 down. But to tie up the deal, he can give that initial $20,000 deposit or something, and the seller is going to give him those 2 to 4 weeks to then figure the rest out. Now, if he gets a week or two into it and has the oh shit moment, like this is not looking good. Either the deal's not looking good because now he's done some inspections and he's checking it out, and the deal really wasn't what he thought.
You have to get the inspections done in this 2 to 4 weeks as well.
Yes.
Yeah.
But that's enough time. It is, Corey. It's enough time to get it done and look at the deal. And your deposit's not at risk at that moment.
At that point, right. So during that time, you're trying to get all these ducks in a row. A, do I still like the deal and want to buy it? B, do I think I'm going to be able to get my investor dollars and my loan on it, right? And so you're kind of working all this jointly. But I would say that, if I'm someone starting out, or if I'm giving advice to someone starting out, I would say, look, don't be afraid to tie up a few deals. Just know that you might have to go into escrow on a few of them and cancel the escrow and get your deposit back. Man, now you've spent some time. Maybe you spent $1,000 on some inspections or whatever. So, you got to have a little bit of money to, I don't want to say waste, but to quote unquote waste and write off on some of the deals you don't buy. But it's better to tie a couple of things up, go through those motions. That's how you're really going to get sharp on what you're buying, and then maybe pull out of a couple deals. But once you find the one that you really want to stick, then you stick and you go hard, right?
Yeah. If he just happened to make that $140,000 non-refundable, would it usually in other situations be refundable had you pulled out of escrow?
Yeah. So if we pulled out earlier, it would have been refundable. So it's basically there's always a time clock of how soon. So basically the seller might say, hey, you got to close escrow in 2 months. You got to close the deal in 2 months. But the first month is your free look period, basically. You can put the 140 grand in, but by the end of that first month, I want to know you're committed. So before I give you the rest of the time to get all your ducks in a row, I need to know that you're fully non-refundable by that 30-day mark or that 3-week mark or whatever it is. So
interesting.
Yeah. During the free look, you can look like we had one, right? Again, we just closed this one, but there was one 6 months ago or something, 6, 8, 10 months ago that we almost bought. And so we put it in escrow. Our deposit was still refundable. We did a bunch of inspections, and we probably spent $4,000 or $5,000 because it was slightly bigger. We spent $4 or $5 grand or whatever.
That you don't get back.
And on inspections and stuff, we didn't get it back. But our deposit was still refundable, so we got the $20,000 or $30,000 back or whatever, and we wrote off the rest. But my point is like you're gonna cancel some deals, but. If I'm someone starting out, if I'm giving someone advice that's starting out, I would say, look, I know it's a scary thing to tie up a deal, but you got to get something under contract, because if you come to, your friends and family or potential investors and you're like, hey, I got this thing under contract. We can buy this thing for $1 million. We got to put down $300,000 or something. I've got 25. So I need 275 from you guys if you want to come in on it.
Yeah, right.
But here's why it's a good deal. And I have it under contract. Nobody else can buy this thing for the next 2 weeks or 3 weeks or 4 weeks, as long as we go hard at some point, right? And do you want to look at this deal with me, right? So that's your first objective, is to get that initial interest from people who say, okay, I'm not giving you 100% yes right now, Greg, but it looks pretty good. So, and I've got 100 grand sitting around, and maybe your Uncle Joey has another 100 grand sitting around. Maybe we could do something.
You're
right?
saying you do that, it gets their attention.
It's all like that one bite at a time.
You're not just talking about a deal. You got a deal in escrow.
Again, if you don't have a deal in escrow, you have no business having serious conversations with any investors.
Yeah, no,
well,
it's true.
it's just, you got to get the deal, because the deal, once you have it under control, then you have something real.
But
you can
that's
go
something
talk to somebody.
tangible, right?
Yeah, 100%.
What is another like detailed question about under that topic, Brandon? You're saying, how do you get these people?
Yeah, well, I think another big, just quickly, that comes up to me is like, people will often ask, like, what do you pay your investors, or how do you decide what the split is with the investors, or are you giving the investors a set monthly payment? Are you just giving them 25% or half of the profit or something when you sell it? Like, how are you doing it? And short answer.
And these partners are called LP partners. They're passive.
Yeah, exactly. The passive partners. Now, and the short answer is, you can do it however you want. Yeah. Right. So we've done it a ton of different ways.
What's like the fiduciary responsibility?
Well, that's
a good question.
That's a good question, Corey. Yeah.
Bottom line is, when you're raising capital, see, it's different if you're taking it as a loan, or if it's what they call equity, right? Debt or equity. So
what is the
there's two
the difference of that. So
yeah.
Let's say you wanted to join a deal with us, but you were like, hey, listen, I really don't want to be a true partner on it, as far as like, we might hit a home run, or we might do this. Like, I want a little bit more certainty. I've got 100,000 I want to put in, but I really need some set monthly payments on it, right? We might negotiate a deal where we pay you 8% or 10% or 12% or something like that, depending on how good the deal is. So in that case, we might say, listen, Corey, you put your 100 grand in, and we're going to pay you, $1,000 a month. Let's just use a number, right? We're going to pay you $1,000 a month till we sell the deal. Now, when we sell it, if we make a $300,000 profit, a $50,000 profit, a $500,000 profit, that's all our money, because you just are getting rain or shine. Likewise, even if we don't make as big of a profit as we thought, in that case, if you want a guaranteed payment, you're going to be considered a lender. You're going to loan us this money. We're going to have a contract for that, right? A loan agreement, promissory note, and a deed of trust. But point is, that agreement's going to say you get that money every single month, right? Bump. Now, it could say anything. It could say you get one payment a year, or a payment every quarter. But the point is, you're a lender, and so you're getting a set return no matter how good the deal ends up working for us. Now, that could work in our favor, because if you're happy with the interest and we totally kill it.
That's like 12%.
Yeah, right. If we totally kill it, make this huge profit, maybe it's better for us that we only had to give you 1,000. If we make a smaller profit, maybe you ended up making a little bit more. And so that's always, it's that, right?
But
that's one structure.
And
that's
debt.
That's debt. That's debt.
Okay.
Because in that case, we're in debt to you. You're the lender. Right. You loaned us that money, right?
Right.
Okay.
And you get a fixed monthly payment.
And that's one way that an investor might choose to invest, but using that term loosely. They're really loaning, but it's kind of like, hey, I'm going to be a private investor on this deal. I'm going to loan these guys the money, and they're going to pay me $1,000 a month. Now, another way,
and then they cash out for the same $100,000 when you
the same 100,000 comes back to them, right?
Right.
And that money will be secured the whole time against the property. So from a legal standpoint, it's all attached to the property,
right?
As collateral. Now the other way, take that same example for that 100,000. We could say, listen, Corey, I could pay you $1,000 a month if you really want that set structure, or we don't pay you any $1,000 a month, right? We no dollars a month, but you're our partner. Maybe you're our 50-50 partner. Or maybe it's 1/3, 1/3, 1/3, whatever. Because we're going to do the work and put a little bit of money in. Maybe we're each going to put 20 grand in or something. You're going to bring 100 grand, but you don't have to do any work. But we're going to do some money and some work. So you just however it works out.
This is equity.
Let's just balance out that deal.
However it balances out. However we all agree. But okay, so in that case, we're like, okay, so when it sells, if we make 300, 400, 500 grand on this thing, or 200 grand, or whatever number we make, you get a third of that, you get a third, and I get a third, right? So then, of course, the question you're asking yourself is like, okay, well, cool. If they own it for a couple of years and they pay me $1,000 a month, okay, that's $24,000. But if they can make a couple $100 grand on it, and I get a third of that, I could make maybe 50 or 60 grand on it. Now, that's not guaranteed. I got to hope the project actually performs and does well.
That's on like a 2-year scale as well.
Right. So you got to weigh it out. But that's, kind of in a simplistic, way from a high level. That's kind of how these deals happen. People either come in as partners and they have like shares in the deal, and everybody's going to ride or die together.
That's equity.
And as an equity investor, like on our deals, right? Like we shoot to have our equity investors effectively make 20-25% plus on their money a year, right? When you figure like the whole, like if we go into a deal like this deal right now, and we buy it for $8 million and we sell it for $20 million, whatever that big pop is that everybody gets, like we're backing into making them 20-25% on a year on their money. Now, somebody else might say, well, that's cool, but instead of having the chance to make 20 or 25%, I'd rather just loan you guys the money for 12% or 10% a year. It's still good interest, and you make whatever you guys make, right? And so usually the point is debt makes less because it's guaranteed. So you'll say to someone, hey, I'll pay you a set fee, but it's going to be 10 or 12% or whatever it's going to be, right? Whereas if you're willing to come in as my partner, maybe we can make a lot more money, but it could be this. It could be a little bit more, it could be a little less, right?
Equity has a pref too. Equity has a quarterly payment associated with it.
It can, and you're getting much more down the rabbit hole, probably more so than, but bottom line is there could be a hybrid is the point. Right. But generally speaking, someone is either a partner where they have shares in the deal, and those are typically people that have a slightly higher risk profile. They get more excited about making a bigger pop at the end, versus there's other people who are just like, hey, I just want my money working. And if I stick it over here in the bank and get 2 or 3% or something, I might get on that same money, I might get $200 a month or $50 a month or $20 a month in interest. I can give it to you guys. You pay me $1,000 a month. Shit, I'm happy. And if you guys make a home run on it, more power to you because I got my 1,000, right? So it really comes down to different investors have different wants and needs. Yeah.
And we've seen them all on our side too. I mean, we've seen debt. People just love the debt, the monthly payments, and then they get their principal back over time. But equity is an interesting play because if you believe in the deal and the deal really changes over the next 2 to 3 years, Corey, now you're talking about getting your original principal back plus 2 or 3 times that. So it can be fantastic. You believe in the deal.
So your $1 million investor, if he chose debt, if he chose to like be a equity investor,
an equity investor,
so he'd make about $250,000 a year.
Yeah.
On the money just sitting there.
Yeah.
Interesting.
Yeah.
So you can see how these deals get very attractive. And by the way, we're only able to pay out those kind of returns because we're going to these massive deals, right? So if we were buying a fourplex, we could never pay out that kind of money, right?
What would the percentage on that be more like? Instead of 25%, what would
it might be 12 or 15% or so. Incrementally it's going to be, but yeah, exactly. And so with the economies of scale, when you have like a 50-unit property, right? Every time we raise the rent, every time we add an amenity, every time we fill a unit, all these things get a renewal, all these things add so substantially to the bottom line that you can literally take a property from 8 million to, my goal of 20 million for this deal, right? So.
And just for simplicity, like a 1 to 4 unit property, Corey, has to get appraised. So when you sell it or you want to refinance it, it gets an appraised value to that piece of property, which means that it has to go with what the market is selling for, like another fourplex in the area or another triplex. That's what they're selling for. So that's the price. But on 5 units or more, it becomes the cash flow. The money that it spins off, that dictates the value of that property, the money, the
versus
income.
Like the market area.
Versus like the market.
Exactly.
So it's almost like you can pinpoint a little bit better 5 units and above because you can pinpoint the income.
Well, exactly. Hunter, I'm glad you brought this up because and a more direct way to say that is commercial real estate is like a business, right?
Right.
So if we wanted to buy this, business here, right? It's a multiple of how much income it makes, and it's the same thing with commercial real estate. The more income it makes, the more someone's willing to pay you. Very simple. Whereas with the house, it's not about the income. It's about, hey, what do the 3 neighbors sell across the street for?
Right.
So it's a whole different thing, right? So in our case, we can buy this property. We don't care what anybody's sold for around. We care about how much income does this make, and can we double that income? Let's say, because then we've doubled the value of the property effectively.
So it's future predictions. So you can predict what you're going
because
to,
what you're going to collect. You put the money in, now it's worth more.
Exactly.
It's bringing in this much money, forcing its evaluation.
Forcing its value.
100%.
Exactly.
And they call that forced appreciation in the business. Exactly. Yeah. That's exactly. That's what we do. Yeah. We go in, we do a value add, a renovation strategy, and and we force, and it's not just renovation, it goes back to, you know, all the little nuances of how you operate that property, but you force that income up and you force that value up.
Yep.
You know,
that's it right there. That's a wrap.
But yeah. So it's, but you know, again, none of this would be possible to even get these kind of deals without capital.
Of course,
like, it doesn't.
It takes money to make money.
It takes money to make money.
Yeah, and you're going to need other people to get where you want to go.
Yeah, and even if you've got lots of money, I mean, you look at actually some of these groups that buy these, like even much bigger properties than we're buying, and they have lots of money, but they still bring in investors because then they can buy more properties and it's economy of scale, and they're leveraging, you know, kind of the situation. And
that's what it is.
It's just, someone said it's a team sport, and it really is. You know, that's what I love about these types of deals is, you know, like when we closed on this deal, man, we got so many texts and calls and emails from all these, and we're still getting them from all these like investors that joined us on this deal that are super excited. They're rooting for us. They're rooting for themselves. They're appreciative to be part of the deal. Yeah. Like, you know, a lot of them are three-peat offenders at this point, because I think this was our third syndication we've done, third major syndication, you know, third major fundraise. And so we've got people that are in on all 3 deals, some people that are on 2, and some people that this is their first deal. But a lot of them are just super stoked. And I think for us, like, you know, we've got 2 customers in this thing, right? We've got our residents that live at our properties, right? Those are definitely our customers, and we got to take care of them. And our other set of customers are investors. Yeah. And they're more than customers. You know, a lot of them are really kind of like family, and actually, well, a lot of them are family because we do have family members in on the deals. Right. And that's what we get up every day to really push for.
I think you treat people, you treat your tenants fair, and you're fair to your investors, and everybody's, you know, it is a team sport. It really is, you know.
Well, and I think, you know, again, when you're raising capital, you got to ask yourself, like, if I was investing in Corey's deal, how would I want Corey to treat me, right? And it really is that simple. Like, when people invest with us, a lot of decisions we make, it comes down to that very simple principle. Like, okay, does Corey want to get regular reports to make sure he knows what's going on in the deal? Yeah. Does Corey want to make sure that the deal's performing and that we're keeping him updated of certain things throughout the year, good and bad, as far as what's going on? Hey, this didn't go as expected, but here's what we're doing. Hey, this is going phenomenally well. Here's when this is going to be done, or whatever, right? So we do a combination of like financial reports, you know, written updates, you know, content and video and different things to keep our investors updated throughout the whole deal. So now they feel like they're really on the ground level with us. You know, they're in the field with us, right? And a lot of them, actually, we get pictures sometimes where they'll be in town, because we have investors all over the country, and someone will be in town and they'll like take a picture in front of the building and send it to us, right? Like, they're super excited. So they'll put the BCGK hat on and stuff. So it's really a cool thing, you know. And I think that's really the silver lining of raising, you know, part of the silver lining of raising capital, right? It can be a slugfest getting it done, right? Like when you're really in the deal, back to the pressure being on, but getting that other side of like seeing happy investors and really making a difference in their lives and a difference in yours, and you know,
listen, we're just getting going, but I feel like it becomes easier, you know, to some extent. You know, people trust you. You have some proven track record, you know, that you've, you know, executed on your plans, and it becomes easier. But the numbers get bigger, you know, so it takes more people, you know, to get going.
Can you leverage your assets against a deal? Is there a way to like be like, I own a house and I want to be a part? How do you do? How does that like work?
Well, the easiest way would be for someone to get like a refinance or line of credit against that property. So like they could go to, you know, Chase Bank and say, hey, I've got this home. It's worth $400,000. Maybe I only have $100,000 that I still own the mortgage, or maybe I don't owe anything on it. Whatever it is, I don't want to sell the property, but hey, Chase, can you give me a line of credit against this as collateral for say $100,000, so I can then go put it in and Brandon and Greg's deal, right?
Oh, okay.
And so we've had people do that. We've also had people that have used their 401k and IRAs because, believe it or not, you can actually use a self-directed IRA to go into these types of real estate deals, and it doesn't disrupt anything as far as with your retirement account. So now people...
Oh, interesting. You can use the stuff.
You can literally use your
IRA.
Yeah, 100%. Yeah.
Huh.
Yeah.
We have a lot of investors that invest with their IRA and their 401ks that have to get converted to a self-directed IRA. But basically, people have these retirement accounts.
Did they say IRA in LA? Is that what they say?
Yeah,
IRA?
IRA, IRA.
Okay. No, I was just like,
exactly.
Okay.
But the thing is most people historically and even conventionally, like, their retirement accounts are mostly stocks, mutual funds, bonds, right? And that's totally great and fine, you know, but there's an idea, back to the idea of like diversifying a little bit. And a lot of people want to get into real estate, but they're like, man, that's where my money is. What the hell do I do with it? And if I just pull it out, I'm going to get taxed, and I'm pulling out of the retirement account.
Yeah, and stocks don't return at that rate either.
100%.
Right.
Yeah. And that's the whole thing, right? With the stocks, you might have a year where it goes through the roof, but you could have a year it falls just as fast, right? I mean, we know somebody, we won't name her, but
Bernie Madoff, you know.
Or Madoff.
Right.
Oh, geez.
Well, I mean,
that
listen.
was a Fugazi situation.
Listen,
there.
at least the one thing the investors know above all else, if their money's going into the sticks and bricks of a real estate deal,
it's there, right?
It's not like,
yeah.
We can't even do anything with it. We take this money, we buy the property, now we operate the property so that we can get everybody more money, right? So it's a lot different than being in some fund or something.
Right. You're secured. You're secured by, brick and mortar and and a roof.
And insurance, right.
Well, don't even go there.
Right.
But
you are. But yeah, insurance market, as we know, that's been a little
But yeah,
it's
crazy. Secured. I think that's obviously a true
Yeah, and so people want to do that. And so with us and with any sponsor, there's a way to do it, and it's a pretty straightforward thing. So people, it takes a few days, and literally they can roll over their 401k or their IRA and roll it right into this real estate deal. Yeah. And it will go directly from their current retirement account to another like custodian, basically, that then puts it into our deal. And then what happens is when we're paying back, whether it's the dividends or the payments or any money we're sitting back, it goes
IRA.
Right. It goes right there. So then nothing ever breaks the whole chain of command as far as it never left the retirement account. It just started changing the way it was done. And so, it's been a big, actually an aha for us, because we didn't know that initially. And a couple of deals back, we figured that out, and it actually opened up to a lot of people being able to invest with us.
Yeah, because now
so many people that have that can just be like, okay, it's one thing if I got to find $100,000 and like give it to them, but if I already got 2 or 3, exactly. But if I already have 200 or 300 grand, a lot of people do $100,000, 200, 300 grand in a 401k or something that's been sitting there forever,
right?
And they're like, hey, I can still keep X amount in there, but I can take that $100,000 out and roll it over into this deal, and now I have some of my money in a real asset in that's producing income. So
it's a good deal. It opens up a whole,
And then you could use your IRA, and so you could fund it with like an IRA or up against your house as debt or equity.
Yeah, 100%.
Yeah. For sure.
So that's a whole different thing, right? And like, so again, going back to like the people that are like, the guy, the little Gregory that's trying to figure out how to raise money for his first deal, you kind of learn as you go. But if you have these couple different options, it gives you more ability to get things done, right?
Yeah,
to get it done. So it's kind of cool. That
knowledge of the market and stuff, it helps. Yeah. And again, these are, I feel like these are progressions. You're not going to start out of the gate being, the genius, real estate investor,
Of course. But, well, I don't know. Maybe little Gregory would. You never know.
Maybe Big Daddy has to tell him.
What do you think? Okay, so what's the hardest part of raising private capital? Maybe the hardest part for us now. It's going to be different for everybody, right?
I think what's
the hardest part?
Yeah, it's probably changed over the years.
Right. It's
what is the hardest
changed.
part about raising capital is finding people and getting in front of more and more people. I don't think it's hard once people realize, the benefits of it, but it's just getting to more and more people.
Yeah.
That actually, know a little bit about you and trust you and, want to take the time to
look. But buy a house, and then so you have to buy a house, $30,000, $40,000, $50,000, buy a house. And another $30,000 to make it worth more money. Then take a loan out against the house.
Yeah,
correct.
And then use that money to play with.
Yep.
Yeah.
Huh.
Yeah, exactly. There you go.
Well, you're right, Corey. It's
exactly.
It's this whole orchestra of financial, doing all these moves with different financial ways to start growing. It's really, you kind of have to orchestrate that a little bit.
You have to know what to do with it. I find as I'm pushing up on 30, and so I'm running into people who have a little bit of money. There's some, it's like, oh God, I got 20 grand, I got 30 grand, whatever. You're like, okay, so what do I fucking do with it?
But Corey, there's probably a lot of caution.
Right. And by the way, that was part of what got me started in this and got my brother and I started in this, because we had some money sitting around, not a lot, but it was kind of like, what do we do with it?
Right.
I could just buy a few stocks and hope something happens. I think at the time, crypto was definitely, was not as hot of a thing as it is now. But the point is like, what do you do with it, right? Well, and if you're like what I was thinking, and the whole reason I told my brother, I was like, dude, I know how this shit goes. when money sits around, it finds a way. It's like they say, you know, like water always finds a way, right? Like, you know, when real estate, right? Like money finds a way to dissipate as well. It will dissipate from your account. Like you'll spend $1,000 here, and let me do this, let me buy that. And also you're like, damn, I had 20 or 30, but now somehow I have like 12,000 or 7,500, and you're like, damn, I should have invested that when I could have.
Right.
I just slowly siphoned all this shit away from myself, right? Like,
Brandon, but there's like more going on too, though, because I'm sure there's tons of cautionary tales that people bought a house, another little house, refinanced, took the money, and then they put it into something and they lost on it. You know what I mean? So I'm sure there's a lot of, I feel like it takes a little bit of luck, but also I felt the plan when Brandon and Chuck had started this and they told me where they were.
What was our pitch to you that got you to come in?
Well, it was, we're in Bakersfield. We're in Bakersfield. I'm like, what the hell are you in Bakersfield for? And then I took a moment to like look at this market and I realized, holy shit. I mean, the numbers make sense on the purchases, on the numbers, but the rent's really robust. I don't know. I feel like there was some luck involved too, because we could have been another cautionary tale. We bought something in fucking Riverside. Nothing against Riverside, but the numbers don't work everywhere. Yeah, and they worked. And then it just, I don't know. There was a little bit of luck on our side too, I believe.
Yeah, definitely a little bit of luck. What do I say? The harder I work, the luckier I get. I think that's a Gary Player quote. And the thing is like, sometimes it's that whole thing about being somewhat prepared, putting in a little bit of the work, a lot of the work, and then timing could kind of move into a little bit of luck there. And so I think timing was right.
It was,
you really, at the end of the day, you have to have a core understanding of your business. You got to have a core business. So if you're going to be, you know, the guy or the gal or the guys or the gals or whoever that's raising the private capital from investors, you better have a good core understanding of your business. And you better have a pretty good plan with some backup plans, some A, B, C, D kind of things if things happen.
We didn't have those. We just
because by the way, because that's also been the attraction for us. We have a lot of people that are in with us on these various deals. They want to go out and do their own deals. Some of them are actually already doing some smaller stuff, but they want to start doing bigger stuff like what we're doing, but they don't really want to go and screw it up. So they're like, listen.
Yeah, because that's a lot of money to fuck up.
It's a lot of money to fuck it up.
So
they're like, hey, if I put $100,000 with these guys and I get an inside look on how did they buy it, how did they renovate it, what kind of loan did they get, when did they pay the investors, how much did they pay the investors, how did they sell it at the end, like what everything. Now, if I do this once or twice with these guys, I can then go do my own if I want to, right? And so a lot of people are that mindset. They're like, listen, I don't know if I'm going to invest with you guys for 20 years, but I'd love to invest with you on a deal or two and see how you guys do it. And we're like, hey, more power to you.
Yeah.
We hope you're charged up and go do your own thing and replicate exactly what we're doing. There's more the merrier. There's plenty of deals to go around. So, but that's also been a nice thing for, a nice attraction, I think, for a lot of people to kind of get in and learn how we're doing it.
Yeah. Because a lot of people don't want to, it's like, I'd like my money to be making me money, but I have to do this other thing that's making the money. I don't have time to.
That's exactly right, Corey. That's exactly right.
1,000%.
Yeah.
And
that's a smart way to go.
Right.
Honestly, I mean, if you trust the team who has the process behind them, who's executed, it's a smart way to go.
Right.
You know what I mean? It's a safe investment. Look at the deal, look at the numbers. As I said, have that. Look at that deck, and we do that. We do webinars on all our properties and stuff, and everybody gets all the numbers. So
I've heard don't invest in anything that doesn't make sense to you.
You
got to go with your gut, and you gotta do your own due diligence.
But if it makes sense, and you're like, okay, let's cost this and bring some.
Right. You're going to have to at some point make a decision.
Right.
Yeah.
Yeah, and it's that old the Reagan quote, the trust but verify kind of thing. It's kind of like you got to have some trust in who you're going to be investing with, but you got to verify and make sure they're doing the right thing.
Yeah.
Because back to your point, that's so important that the execution happens.
Yeah. What are some common mistakes to avoid common mistakes to avoid when raising capital?
Raising capital.
Wow. Common things to avoid.
Like what's something that I wish I knew this.
Yeah, exactly.
Things to
That's
avoid when raising capital. I mean, avoid not knowing your deal.
Yeah, I would say a big part of it is, we struggle with this on the last deal a little bit. It wasn't a struggle, but we wanted to start raising the money earlier. Because back to that time clock, with the sellers, you got so much time. And so the first day we're in escrow, we'd like to start raising money. But we've sort of learned that sometimes, again, fast is slow, slow is fast, right? And so if you go run out and talk to a whole bunch of investors that might have been interested in the deal, but you talk to them too early, and you don't have your shit together, you haven't done any inspections, you don't have a pro forma, there's no numbers, there's like, you're very like, I'm gonna have to get back to you on everything they're fucking asking you.
Right.
Well, those people may be gone for good on that deal, because now you've lost credibility potentially. They've lost some faith or trust in you or the deal, or they just think you're unsure about it. And so I think a mistake would be, don't hard pitch investors too early. Tie up a deal. You definitely want to start putting your feelers out. And it's okay to tell people, hey, I don't have all the numbers and everything figured out yet, but I'm just trying to kind of take a warm temperature of anybody that might want to join. And in the coming week or 2 or 3 or whatever, I'm going to have a real professional package to sit down with you and go over. So that all being said, are you liquid right now? Do you have some cash? Is there some interest level? I just want to put a star next to your name if I can come back and talk to you about this deal, right?
Yeah.
And so that's what we did on the most recent one. We wanted to start raising money way earlier, but we took about a month or month and a half maybe even into the deal before we even approached one investor seriously, because we figured, hey, the stakes are high on this thing, high stakes deals, baby. And and so we were like, listen, we can't F this up. We want to go to people the right way. And so we were lightly building an interest list, but we definitely didn't try to hard pitch anybody until we knew our shit.
We were ready.
So we could look them right in the eye and say, this is what's going on with this deal.
Right.
So anyway, that would be one mistake to avoid, is don't pitch investors too early.
Too early.
What else would you say?
Well, I just said know your deal. You know what I mean?
Deal.
And avoid. You must know that deal. You know?
So what about letting people invest in the deal? I know it sounds about bad, like letting someone invest, but it really is, because once you start building this credibility, right? There's investors that might want to give you money, but they come with a lot of baggage.
What does that mean?
Well, it could be like they want to call you 10 times a day. Like we want to be transparent guys, but you can't have someone calling you 10 times a day.
Investors?
They might be a real pain in the ass. Like they might have like a CPA and a dad and an uncle and 14 people on there, and that they want you to do 14 calls with, and they're going to be in your office every day. Like, there is a fine line, right, between being transparent and appreciative that investors joining you and updating everybody and being an open book, versus some investors are just high maintenance. They could be too high maintenance, because again, these are going to be your partners through this deal. So if they're if your personalities don't click, or there's some reason you think they're going to be busting your shit every day about something, about something that they shouldn't be, like how to run this deal, and they're going to be in there every day trying to micromanage you or something. Like, those are the investors. If you get that in that impression early on, it's better to say, hey, listen, I appreciate it, but we're not going to do this deal together, and find someone else for that chunk of capital. Because the last thing you want, especially on these deals like we're buying, these are 3, 5, 7-year deals, right? They're not like a 2-month deal. So if you get some wrong investors in there that are really a pain in the ass, you're going to have to buy them out at some point, or you're going to have to deal with them for the 6 years or whatever. But it's just, you don't want to take money from people that you can't at least, I don't want to say get along with, but there's got to be some connection there that you're like, hey, I'd like Corey to be in our deal because he's a good guy, versus like, hey, Susie over there is really crazy, and I appreciate she wants to give us the money, but there's no way we can do this deal with her. So you just have to kind of have that gauge a little bit. Don't just take money for the sake of taking money, because it could be a big pain in the butt later for you.
Yeah, you got to be careful. People can just take up your time, and you can't do this on scale. If you had 2 or 3 people like that on your deal, you'd spend all their time, all your time answering their questions. So you can't do that on scale. Maybe on smaller deals to get started, you may have to entertain that. But you're right, though. They could take up all your time.
I think another mistake would be not having the right legal paperwork. So whether someone's coming in as debt or equity, the paperwork does change. Particularly if somebody is coming in as equity or partner, you need to have what's called a PPM. It's a private placement memorandum. And if you're thinking about raising capital, particularly equity partner capital, and you don't know what a PPM is, you better get very well versed in that, because DM us. That's a good point, and we'll be happy to send you some free resources. We'll even connect you with our attorney that does all of our PPMs. But you got to have this document, and the PPM basically spells out what your business plan is, what your resume is, why you like the deal, what the numbers are on the deal, what your projections are as far as how you think you're going to get 20 or 25% a year for these investors in our case. Like, whatever the deal is, it spells everything. But it also spells out the risk. It says, hey, maybe you shouldn't invest if you need money tomorrow, because this is an illiquid investment, and the money could be tied up for 6 or 7 years if they keep it this long, right? It's going to spell out everything in there. So you have to do that legally if you're a sponsor, as they call it. If you're a general partner, if you're someone that's raising the capital, you got to have that PPM because, again, what happens
like pros and cons.
Yeah, because
There's
listen,
but it's all spelled out.
Right, because think about it like this. If you invest in the deal, Corey, and we don't have you sign that document that says, hey, Corey, listen, you're investing at your own risk. This is like anything else. You know, could make a lot of money. It could make a little bit of money. It could actually lose some money, right? So you're relying on their execution, on facts of the deal, on certain market circumstances. Like, we're all going into this with good intentions. Now, if there's fraud, if we steal any money, if we're bad actors, that's a whole different story, right? Now our asses are really effed, right? But if we do everything on our part right, we didn't steal a dollar. We followed the business plan. We were very transparent with you. We went into this thing with best intentions.
Yeah.
And God forbid it does lose some money.
Right.
And let's say you put 100,000 in, and at the end we're like, dude, we can only give you 70 back. I'm sorry. Like, everybody's taking a haircut, and we got to get out of this deal. It wasn't the right deal, and we learned a lesson. That could happen. Right. It's never happened for us, and we don't expect it to happen. But but the point is, that's what that PPM says. So now you've signed that. So then later you might be mad. You might be mad. You may not want to invest with us again, or you might want to invest with us again if you've done a few and maybe one lost a little and you made a lot on the others. Like, that's going to be up to you to decide if you want to keep investing with us. Right. But you can't come back and sue us. Right. If we've done fraud or something illegal, absolutely, and we'll end up in jail. But but here's the thing: if I don't have you sign that PPM, you can't, and I lose even a dollar, you could come back and sue us later. Right. You never told me this was risky. You never told me I could lose a dollar on this thing. Yeah. Well, Corey, I mean, it kind of goes without saying, you're a partner. We're like, we're all going in on this thing. Right. No, Brandon, I never thought I could lose a dollar on this thing. I'm suing you right now. So a big mistake would be if you're raising private capital as far as equity from investors and you don't have a PPM, you could really get in trouble. So make sure that you
drafted by an attorney, all done.
Yeah. Now, again, I will say, without getting too overcomplicated on the technical stuff on here, again, if Corey's a lender, if he's loaning us the money and he's getting a set $1,000 a month and we give him the property as collateral, you don't need a PPM. He's a lender. But
that 100,000 comes back to me.
Right. And you're
secured by the property.
Right. Yeah. But if your only way to make your money back is relying on the plan of the business and you're a partner, then you got to sign a PPM, because that will spell out all the risks involved with that investment.
Right. So very good.
Glad you asked, because that was an important
good question.
Yeah.
How are we doing, Corey?
We're doing good. We got about 5 more minutes.
Okay.
Well, that's good, because Greg could talk for like 50 minutes. So
I don't know. I'm drinking all my coffee. Brandon's doing a lot of talking today.
Yeah, it must be the puffy jacket. I'm just getting puffy over here. I'm like, let's go.
How do market conditions
you take this one, by the way. Go ahead.
Influence capital raising efforts? Do they?
How the market conditions influence?
Great question. And they
that's a great question. Yeah. Go ahead, Brandon. Take that one. No, market conditions and capital. What was the question? Say it again, Corey.
How do market conditions influence capital raising efforts?
Well, geez, I mean, my quick answer is it just comes down to the numbers again, because the market condition, again, a Bakersfield, a Sacramento metropolitan area market conditions are different from a Los Angeles or a Riverside market, so that would affect the deal. That would affect the numbers.
Let me just jump in.
That's my quick answer.
No, and that's a great. Let me ask the question. So a question back to the question kind of thing. So are you basically saying, like, if we're in a recession, if there's a COVID going on, if it's an election year, if it's the holidays, like if you're trying to raise capital from someone and there's something weird going on in the marketplace that you can't control, does that affect your ability to raise capital?
Well, that's a really good question, but I mean, the numbers are the numbers. You know what I mean? But that's still, you have to take that into effect.
So it's like, do you have cash or not?
Well, yeah,
but maybe it influences the future.
I would answer it a little bit differently, and I think that's a good answer. I think what you're basically saying is, look, if you've got a good deal, if you got a good deal, you know your shit, and you're talking to the right people, you should be able to get a deal done.
But you got to be aware. Right? You got to be aware of the market conditions.
The way I would answer it would say, look, we can use this that we just closed as a very real case study, right? We went into escrow on this deal, I want to say September. Yeah. Late September, early October.
Yeah.
Election year. So people are already kind of like, I don't know which way on every side of everyone's just kind of like, I don't know. I don't know what's happening. Interest rates are still pretty high. Right. And so people are kind of like, is it really the right time to be in real estate? Rates are a little high. Holidays, we had to raise money through the holidays. And so try to get someone on the phone in November or December, especially December. Right. Yeah. And talk to them about taking money and putting money into a real estate deal. You know how many people told us, Call me back in 2 weeks. Call me after the new year. Guys, yeah, maybe, but I don't want to talk about it right now. You know, that was so
right.
I don't know if that's a market condition as much as timing, but yeah, I would say, look, you got to be a realist too. You want to be optimistic, but you got to be real. If you're trying to raise private capital during COVID, if you're trying to raise private capital during, you know, some weird recession that just started or right next to an election or the holidays, you can just expect that you're going to have to talk to more investors.
Yeah.
So you have to cast a much bigger net. Maybe you got to talk to 50 or 100 people to get the same amount of money raised that you would have gotten from talking to a couple dozen, right? So you got to talk to more people and move fast through the nose. And you also have to anticipate that they're not going to move as fast. So even if you say, yeah, Brandon, I'm in, I'm already kind of figuring, okay, it might take you a couple weeks to move money around or get back in town or whatever.
Right.
So and we saw that in this deal. I mean, we were in escrow for almost 3.5, 4 months because, I mean, once we got into the vortex of the holidays and the LA fires, we had people that wanted to join us. But because the fires were going on, I mean, we can't be insensitive and be like, hey, I know your house might be burning down, but can you meet me at Starbucks and talk about an investment? Like, you got to just put that on ice for a little bit, right?
And were you able to extend the time?
And so we were able to extend. So because we had gone hard on our deal, on our deposit, because the seller knew that no matter what, they were going to get that 140. They were like, he was like, hey, I'll give you a little extra time on the escrow. I'll give you another month to close, basically.
Right.
And we ended up giving another $15,000 for that, actually. But that, you know, that was okay at that point because we were like, hey, you know, $8 million deal, another $15,000 to get some more time.
Right.
So it wasn't a problem. But yeah, that was kind of how the conditions, you know, affected it. It's just you're gonna probably get more no's. Look, if the real estate market is humming, you know, and everybody outwardly knows that it's a good time to be buying real estate, and it's a good time of the year, and there's nothing weird going on in you know, anywhere else in the world or in the U.S., then yeah, in theory, you probably have a much easier time raising capital. When things are a little weird, just be prepared. You got to talk to more people is the bottom line. And the people that give you yeses, it's not really a yes until you see the money hit the account. Because we had some people that were like, dude, I love this deal. I love this deal. I'm going to put in $50,000. All right, cool. Hey, Joey, appreciate it, man. Here's the paperwork. And then like 3 days later, like, it's bad timing for me. I can't do it. Or I changed my mind. I talked to my CPA and he wants me to do something different. So so you also got to anticipate, I think even more so if there's weird market conditions going on, that it's not a yes until you see the dollars in the account. I mean, because even people, if they sign the thing, they might say, I know I signed it, but Brandon, I can't do the deal right now. So we had a lot of that stuff. But yeah,
there's some reluctance because people and money, it's emotion.
Right.
You know, and so they say yes, but then they, you know, they have to buy a new car or they got to move or something. So there's a lot going on. And so Brandon's right. You know, you got to talk to more people. You know, you got to get in front of more
and that's
people.
what Greg's good at doing. He's good at bugging people on the phone. So I'm just going to tell you guys right now, you don't want to be on Greg's call list, because if you're on Greg's call list, you'll get a call at 9 a.m., at 9:45, a text at 10:15, a call at 11, a call at 11:30.
Are you saying you're saying I just like to talk, and that's true.
Yeah, I'm also saying you're like a professional, like bug people over the phone guy, but it's a good thing because it actually gets shit done. So I'm glad that I work with you, but you just don't want to be on that other side of that thing, you know?
Yeah. So,
but no, listen, we could talk forever about raising private capital. There's a lot to unpack. And I think the main reason we wanted to talk about it today is because it's such a important part of this equation. Again, if you're a guy or gal that's getting started, or even if you've been started for a while, if you're gonna really grow your real estate investing business, you're going to have to consider raising capital. And there's a lot of nuances. So hopefully today we answered some of those questions or gave you guys some ideas, or, you know, you heard the term PPM for the first time and now you're going to go research it, please. But, you know, like Greg said, DM us if you guys actually want more information. We're happy to talk about the subject and give you guys,
Brandon can talk about it all day.
I learned so much stuff.
Oh, you
Dude,
did.
I love that, bro.
With that, we served our purpose.
Yeah. All right, guys. You heard it here, the high stakes deals. Thank you for tuning in, and we'll be back next week. Let's go.